Welcome back to Campus EasyLearn Media, and this is going to be our first video presenting on autonomous branches. So we are going to look at, because we looked at previously looked at centrally controlled branches, and now we are going to be looking at autonomous branches. So autonomous branches, we call them autonomous, which is the same as independent, simply because for them they are given that independence to purchase their own goods from local suppliers, whereby you are going to see that even the head office is going to be supplying to the what? To the branch. So the head office becomes a supplier. That's why you are going to see that when we are recognizing, we are going to be recognizing the branch and the branch books, because here the head office is going to be preparing its own books of account, and also the branch will be preparing its own books of account. But you are going to see that the head office, in the head office books, they will maintain a special account called branch current account, and also in the branch books they are going to maintain a special account called head office current account. These two accounts are maintained for purposes of reconciliation, in a way that what takes place in the branch, the transaction between the head office and the branch. For instance, if maybe we recognize something like goods are sent, because you are going to see, you look at the effect of the transaction on the head office and the branch. So when you say you encounter a transaction like goods are sent, you say, who sends the goods? It must be the head office sending the goods. So that's why if you meet a transaction showing goods sent, even if they don't include in the word goods sent to the branch, it must be the head office sending the goods. So when they say goods sent to the branch, I'm writing it on the side of the head office because the head office is going to send the books, the goods to the branch. So when goods are sent, I'm supposed to be passing a double entry, debit, credit. So when I'm passing a double entry, I recognize that I'm the head office, I'm preparing my books of account. When I'm sending goods, I'm getting them from somewhere, that special account where I'm getting the goods is goods center account. So it is reducing, I must be crediting that account, goods sent account. Then where are they going? They are going to my branch. So since they are going to my branch, I must be debiting the account I'm maintaining, the branch current account. Branch current account, me as the head office. So when I send, the branch has to perform a lot of receiving. So you will be encountering transactions like goods received by the branch. So when the branch receives goods, it's supposed to also be passing a double entry. So when they receive goods, of course they are going to be debiting the branch inventory, the inventory they are trying to sell, branch inventory account, because their inventory is increasing since they have gotten goods from the head office. So but where are they coming from? It is coming from the head office. The account are maintaining head office current account. So that's the first entry. Then you can have cash remitted or cash sent. But you recognize who sends cash. Of course, you are seeing that the branch is just selling goods on behalf of the head office. So the branch has to sell those goods and send the money where it belongs, to the owners, and the head office is the owner of that cash. So who sends the cash? It must be the branch sending the cash. So we have to record that transaction in the branch books, because it is the one that sends cash or remits cash to the head office. So cash sent to the head office or remitted to the head office, you're supposed to be passing a double entry, debit, credit. When you send money, you recognize that your branch cash account is reducing because you are sending it, you are losing it. So branch cash account, I credit my branch cash or bank account, because I'm losing money, I'm sending it to the head office where it belongs. But where is it going? It is going to my head office. So cash at the head office is increasing. Head office current account. So when me as the branch I send money, in the head office books, the head office is supposed to recognize that it's receiving money. So the transaction this side will be cash received from the branch. Of course, when the head office receives the money from the branch, it's supposed to recognize an increase in the head office cash account. So debit head office cash account, and debit, and credit, you debit head office cash account because you've gotten money. Then you recognize that it is coming from your branch, the account you maintain. So credit branch cash, branch current account. Then you go to another transactions. So other transactions that you can encounter, for instance, you can have returns to the head office. The branch can return the goods to the head office. Returns to the head office. So we pass the journal entry. Of course, when these ones return, these ones you are going to be having this the opposite transaction as returns from the branch, and the head office books now returns from the branch. Returns from branch. So we shall still be passing a journal entry there. So here, when the branch returns goods to the head office, it is supposed to recognize that the inventory is trying to sell is reducing. So they are supposed to be debiting the branch inventory account because their inventory is reducing. They are returning it to the head office. So they credit the branch inventory account and show that it is going to the head office. Debit the head office current account. When you come this side, returns from the branch. Now the head office is recognizing that it is receiving goods from the branch. So they have to go back where they came from. They came from a special account called goods sent. So I debit goods sent account because now goods are increasing in that account. Then I credit where are they coming from? Branch current account. In other words, you are showing that goods are reducing in your branch current account, and they are increasing in the account from which you got them. Then you can have so we can have other things like branch profit. The branch may make a profit, so you can have a branch profit. When the branch makes a profit, what's supposed to be in its journal entries? So when the branch makes a profit, we need to understand that profits are incomes and they increase by crediting. But then you're going to see that, of course, the branch is going to make a profit, but even the head office has to recognize that because I'm going to say branch profit this side. When the branch makes a profit, what happens in the head office books and the branch books? So a profit is an income which increases by crediting. But when the branch makes a profit, we need to understand that that profit doesn't belong to the branch because the branch is just helping us to sell goods at the end of the day, and they must give that profit back to the head office so that the head office recognizes its profit from the branch. So when it makes a profit, it can't recognize it as its income. So in other words, if you recognize it if the branch recognizes the profit as its income, this side in the head office they will be debiting it, recognizing an expense. So the only way of the head office recognizing that profit as their income, because that profit belongs to the head office. So it must be credited in the head office books as an income. So it can't be credited this side. In other words, you are supposed, if the branch makes a profit, it's supposed to be debiting the branch profit or loss account. Then it credits the head office current account. So that when they send that profit to the head office is supposed to be recognizing an income increasing by crediting. So they debit their head office profit or loss account with that branch profit. Then they debit it, they show that it is coming from the branch, the account they are maintaining. The branch current account. So that's it basically. Then we are going to look at so these are journal entries, the most common ones. Then we are going to look at situations whereby you have items in transit. So items in transit, basically items in transit. Here we can have goods in transit, we can have cash in transit, we can still have returns in transit. For instance, goods in transit, you are going to look at the head office sending goods. Maybe the head office goods that are sent, worth 8,000. But what is received by the branch? Goods received. Maybe what is received is 7,500. So you recognize that what is sent is not equal to what was received. So there must be some balance, which is 500, which we take as our goods in transit. And the double entry for goods in transit, all items in transit, the double entry is with debits. We are supposed to be recognizing that all items in transit are assets. So we debit all those items in transit because we take them as assets, all items in transit. Then we credit the branch current account. So whether it is goods in transit, can be cash in transit, that the cash that the branch sent to the head office, maybe cash that was sent is 5,000 and what was received is 4,500. It implies that there is some cash in transit. So you're supposed to be debiting that cash in transit, then you create branch current account. If it is goods in transit, you perform the same operations. It can be returns in transit. So That's the common double entry we pass. For items in transit, take them as assets. We debit all items in transit, then we create the branch current account. So you are going to see that items in transit are the main reason why you are going to see that these accounts, the branch current account and the head office current account, may not be reconciling, because those two accounts are maintained for purposes of reconciliation. So what the closing balance of the branch current account must be exactly similar to the closing balance of the head office current account. So we are going to look at examples whereby we are looking at how we prepare these both accounts, the branch current account in the head office books and the head office current account in the branch books, because we say that the head office maintains the account of the branch, and also the branch maintains the account of the head office for purposes of reconciliation.
Action.
Okay. So we are going to be looking at how the application of how the two accounts, the branch current account and the head office current account, in the books of course, the head office and the branch respectively. So you are going to see, of course, they will give you a question and they give you transactions relating to the head office and transactions relating to the branch, and it is upon you to see whether the closing balances of the two accounts, that is the branch current and the head office current, if they are the same, because they must be the same. So if they are not the same, it means that there are some items in transit, because they are the ones that bring the divergence. So you're supposed to recognize those items in transit and then incorporate them, pass the double entry that debit all items in transit, credit the branch current account. So if we reconcile like that, then we shall get what? We shall get those figures to reconcile. So we are going to be doing this example. So I think you can write it down so that when we start, you have it somewhere, because we are going to be rubbing off this example to get space where you can write. So we are going to work out that example which you have just displayed. So remember, you have to work it out. You have to show what happens in the head office books and what happens in the branch books. So the head office, we said it maintains the account of the branch. So it means I must be recognizing the branch current account, the account the head office maintains, branch current account. And then in the head office, I'm supposed to be recognizing in the branch books, I'm supposed to be recognizing the head office current account, because the question was saying that prepare the following accounts for the year ended 31st December 2000. That is the branch current account, which is this one, the branch current account, which is maintained by the head office, and they were also requesting us to prepare the head office current account, which is this one, and we take note that head office current account is maintained by the branch. So the head office has to maintain the book of the account of the branch, and also the branch has to maintain the account of the head office for purposes of reconciliation. But you must take note of the relationship between the head office and the branch. We say that the relationship between the two, of course, the branch, in the books of the head office, the branch must be a debtor or a what? A debtor or a customer. I'm going to change the marker. So in the books of the head office, this branch is a debtor, because it's just selling goods on behalf of the what? Of the head office. Those goods are not belonging to the branch. It has to remit back the money. So this is a debtor, or our debtor, or our customer. Debtor, all customer. But in the books of the head office, in the books of the branch, this head office must be acting as a supplier. He's our supplier, because he's one of our suppliers. So this is a creditor or a supplier. So in the branch books, they must recognize the head office as a supplier. So now this relationship helps us to know where the opening balances fall. Obviously, since this is a debtor, he must be having the opening balance this side. Balance brought down. And since this is a supplier, his opening balance must be this side. Balance brought down. So when you check the question, when you read through, they gave you the branch current account and then the head office current account. Those 500, those are the opening balances of the two accounts. So since they are similar, I just record 500 here, and this one I record 500 still. So this is the branch current account maintained by the head office, and this is the head office current account maintained by the branch. So I look at the transactions. Goods sent. I ask myself, who sends goods? It must be the head office sending goods. So I look at the head office books, because it is the one that sends goods. And when I send goods, I'm supposed to be passing a double entry, debit, credit. When I send goods, I recognize that they are reducing in an account where I get them from, goods center account, and they will be going to my what? My branch. So I debit the branch current account. But they haven't told you to prepare the goods center account, so you ignore this transaction and pass this entry, the debit only, because it is the only account we are seeing here. So I'm supposed to be debiting branch current account with goods sent. So this is the branch current account. I debit it with goods sent. So goods goods sent, which is the figure was 3,000. So that transaction is done. Then you go to the next transactions, goods received. You ask yourself who receives. It is the branch to receive. So you immediately go to the branch books. And when it receives, it must be debiting, passing a double entry in the books. So when it receives, it's supposed to be debiting the branch inventory. The branch inventory, its inventory is increasing because they are getting goods from the head office. Then it credits the head office because now they are getting it from the head office current account. So it means I'm supposed to come here and this they haven't asked me for the branch inventory account, so I ignore it and I pass this into the branch current account. I mean of the head office current account. So this is the head office current account. I'm supposed to be crediting it with what? With goods received, our inventory. So goods received were 2,800. So I recognize that. Then I can look at other transactions. For instance, cash received from the branch. Who receives money from the branch? It must be the head office. So I look at the head office books. When I receive money, me as the head office, I'm receiving money because that's, I think, the first one was cash sent. Before that, cash sent to the head office. It must be the branch sending money. So I must be operating in the branch books. When I send, me as the head branch, I send money. I'm supposed to be passing a given entry. So they are saying cash sent. It is the branch to send. That's why I'm operating the branch books. So when I send, I recognize a reduction in my branch cash. So I credit branch cash account, cash or bank account. Then I show that it is going to my head office. So I debit the head office current account. So this account must be debited with cash sent. So this is the head office. I say cash sent. Of course, they haven't asked you for the branch cash account, but this one was asked. So you ignore this and you pass this entry. So cash sent is equivalent to 2,600. 2,600. Okay, 2,600. Then you go to another entry, cash received. So who receives money? Of course, it must be the head office receiving money. So that entry must be in the head office books. So and when the head office receives money, it's supposed to pass a given entry. It's supposed to debit head office cash account, cash or bank account, because they are receiving money. Then they credit, they show where it is coming from. The branch current account is coming from your branch. So you credit the branch current account. So we credit it because it's where it's coming from. So you're going to see that in the double entries, one of the accounts must be the account you are maintaining. One of the entries you pass must be the account you are maintaining. So we are supposed to be now, this one they haven't asked for the cash account, but they have asked for this one. So we are supposed to be crediting the branch cash account. I mean the branch current account here. So we credit the branch current account with cash received. Cash received. It is, the figure was 2,500. 2,500. Then you continue, you go to branch current account. Of course, these opening balances, I recorded them. Then branch profit for the, of course, branch profit, you remember what we said about the branch profit. It affects both. The head office has the way it recognizes that profit, also the branch has the way it recognizes. So they are supposed to be passing the entries, both of them, debit, credit. So if it is a branch profit, remember it is profits and incomes and they increase by crediting. But in the books of the branch, I can't record that profit on the credit because I'll be recognizing my income increasing. Yet it is not the fact. So it means you can't recognize that as your profit. That profit must be recognized now by only the head office, because that profit you make as a branch belongs to the head office. So if it is a branch profit, in the branch books you can't recognize that as your income. It is not your income. So you debit that profit. So debit the branch profit or loss account. Then you recognize that it belongs to the head office. In other words, you are crediting head office current account. Then when you come this side, the head office now receiving that profit, it must recognize an income in its books of account. So it will be debiting the head office profit or loss account to recognize that incomes are increasing and you are crediting them. Every time you credit the profit or loss or the income statement, you are recognizing incomes increasing. But when you debit profit or loss or income statement, those are expenses increasing. So for them in the head office, they are recognizing this income increasing. Then they show that it is coming from the branch current account, the account they are maintaining. Branch current account. So you look, for instance, here they haven't asked us for the what? For the profit or loss. So I ignore this and pass this entry because it's what they are asking. So I'm supposed to be debiting branch current account with what? The branch profit. So I put branch profit, which was 800, I think, 800. Then this side they haven't asked me for the head office, the branch profit or loss account. I ignore it. Then I pass what they have asked me, the head office current account, which is this one. So I'm supposed to be crediting it. So I credit it with branch profit, which is 800. At the end of the day, you are supposed to balance off these accounts and see if the closing balances are the same. If they are not the same, it means that you have to understand that there are some items in transit. So you pass the entry for items in transit to reconcile because they must be the same. So we can start with this one. So when at the end of the day, you are supposed to balance off these accounts and see if the closing balances are the same. If they are not the same, it means that there are some items in transit which you need to pass. We remember the account, the double entry for items in transit. We are supposed to be debiting all items in transit because they are assets in transit. Then we credit the debit items that we credit the branch current account. This is the double entry for what? Items in transit. So in case we balance off and they are not agreeing, it means you are supposed to pass this entry to make them to reconcile. So I'm going to start with this account. Of course, when you add this account, this side 500 plus this 800 plus this, you'll be getting 4,300, and this is 4,300 still. When I subtract to get the closing balance here, they carry it down. I'm going to be getting 4,300 minus 2,500. I get 1,800. 1,800. So I have to check whether this balance is the same. Same with this, the closing balance I get this side. If they are not the same, it means there must be some items in transit. So I balance off still. This side I think is bigger. So 2,800 plus 500 plus 800. This side you get 4,100, and what is it to balance off? So this minus this, 4,100 minus 2,600, I get 1,000. My carry down this side is 1,500. 1,500. So you are seeing that at the end of the day, these closing balances are not the same. At the end of the day, these closing balances, this one and this one, they must be the same, but we are seeing that they are not the same. It means that you have to pass this entry to make them reconcile. In other words, debit all items in transit, but they haven't asked us for accounts of items in transit, but they asked us for this account, branch current account. So it means I must make adjustment on the branch current account here to make this balance look the same as this one, because this one is okay, because this is the double entry we pass. So you're supposed to be crediting the branch current account with items in transit. So I check for if there is an item, any item in transit. So it means now we can now make adjustment on this account because it is what we are required to make adjustments on. So I check for an items in transit. Items in transit, one way of checking for them, you check whether the goods that were sent are equal to the goods that were received. So what was sent, for instance, in the question they are saying that what was sent is goods sent were, what was sent, goods sent were 3,000, but what was received, goods received, what was received is 2,800. So it shows you that there is a balance of 200. So this balance of 200 is what we call goods in transit. Goods in transit. So it means you have to recognize it, debit the goods in transit account, credit the branch current account. So we are going to be crediting the branch current account, which is this one. So I must be crediting the branch current account here with goods in transit as the detail. So goods in transit, it is 200. You've seen it is 200. So it is 200. Then I check for whether the cash that was sent is equal to the cash that was received. So when you check, cash that was sent was 2,600. So when you go to the thing of cash sent, the cash sent was the cash that was sent was 2,600. But what was received? Cash received from the branch is 2,500. So it is showing you right away that you are supposed to you are having some cash in transit, because what was sent is not equal to what was received. So the cash in transit is 100. So the debit of items in transit, we debit all items in transit. In other words, you'll be debiting the cash in transit account, then you credit the branch current account. So still you credit the branch current account here with cash in transit, which is 100 in this case. So when you check the question, I think items in transit are done. So it means now you can rebalance off this account and get the new closing balance and see whether it will reconcile with this one of the head office current account. So I balance off this side and this side. Still this side is greater, and we're getting the sum of that, the total as 4,300. So if I check 4,300, 4,300 still here. Then 4,300, I want to get the closing balance now. Carry it down. 4,300 minus 2,000 minus. You'll be getting 1,500. So you are seeing that this figure at the end of the day, the closing balance of the branch current account is similar to the closing balance of the head office current account. Therefore, they have reconciled. So what brings the problems of those figures not being the same is items in transit, basically. So you have to reconcile. In other words, you have to pass the demand of items in transit to make those accounts reconcile at the end of the day. Yeah. So we are going to be doing doing this question, whereby you can be asked to prepare a combined statement of profit or loss for both the branch and the head office. So we are going to pass through this example, and we see. Of course, here you are going to see that you are going to simply be preparing the income statement, but in a T format, in the form of a T account. So basically, as long as you know the format for the income statement, here you are going to just be drawing the income statement. But when it is in a T format, so that's what you are going to do. So you are going to see that we shall still look at that additional information and what is required basically to prepare the branch current account, to reconcile the head office and the branch current account balances. Then we are required to prepare the KTL, this combined statement of profit or loss for the year ended 31st December 2018, and the statement of financial position as at that date. So we are going to start and we are going to work through that question. But you should take note that if you are going to be following with us, you need to maybe write down the question so that when you are passing it through the question, you don't get confused as to where we are getting the information from. So of course, like the question, I think you've copied down the question. So because we are going to be passing through that question. So the question, the first Roman numeral, part A, is required to prepare the branch current account to reconcile the head office and the branch current account balances. So they have requested us to prepare the branch current account. They haven't made mention of the branch. I mean the head office current account. So you are restricted to preparing only one account, which is the branch current account. That's why I'm drawing up one account, because they have requested us to prepare the branch current account. They haven't said prepare the current account to reconcile the two balances. They have only mentioned prepare the branch current account. So what I'm opening up. So since it is the branch current account, it means I'm the head office now maintaining this account, head office books. This is the head office books. Since it is the branch, because it is the head office to maintain the branch current account. They want us to reconcile the balances, because if you check that question, you are seeing that those balances in blue, they are different. The head office current account has a balance of 103,000. Then when you go to the branch current account, it is having a balance of 120,000. And in fact, they are in millions because they reduced the zeros. But this is 10. The head office current account balance is 103 million. But when you go to the branch, it is 120 million. Yet those balances, we've seen in the past evaluation that those balances have to be the same. So it means you have to reconcile. So I'm going to start knowing that in the head office books, this branch is my data. So its opening balance has to be on the what? On the debit. So I recognize that balance, wrote down. In the question, of course, they gave it to me as 120 million. So you can put 120 here. 120 million. Of course, if you reduce the zeros, even in the T account, show that you have reduced those zeros to illustrate that this figure is in millions. So I continue. Then it means that what has brought those two balances not to be the same is items in transit, because we talked about that. That is the items in transit that basically bring about the imbalances into all the divergence between the two balances. If they are not the same, you look out for items in transit. So when you check your trial balance, when you check this trial balance showing the combined data for head office and branch, you're not seeing any items in transit. But when you go to the additional information, the note, that note which is note 2, they are saying branch deposit, the branch deposited, but we don't have to go to forget the double entry for items in transit. We said we debit all items in transit because they are assets. Then we credit the branch current account. So we are supposed to be passing this double entry in relation to items in transit. So I look out for items in transit. When you check note 2, they are saying the branch deposited 6 million on behalf of the head office. The branch deposited 6 million on behalf of the head office in the local branch of the company's bankers on 31st December 2018. No record has been made in the books of the head office. These are the books of the head office, but they haven't recorded that amount of money. So we recognize that is cash in transit because they deposited it, but we haven't recorded it in our books of account. So that is cash in transit, and the other one with debit items. So I debit cash in transit, then I credit my branch current account. So they haven't asked you for the cash in transit account, but this one is asked. So you ignore this and pass this entry. So I'm supposed to be crediting branch current account with cash in transit. In the transit of 6 million. So that is 6,000. We reduce the zeros, of course. Then you look out for another item in transit. Look out for another item in transit. Here they are saying that at the end of the year, goods in transit amounted to, still on note 2, they are saying at the end of the year, goods in transit amounted to 11 million. So if there are goods in transit, I debit goods in transit. Then I credit my branch current account. So I pass the credit entry here. They haven't asked me for goods in transit account, but this one is asked, so it's what I maintain. So I debit with goods, I credit with goods in transit. They said it is 11 million, so that is 11,000. We reduce the zeros, of course. So I can now, of course, you check out if items in transit are done, then you can balance off your T account and see whether the balance will reconcile. So I think this side is greater still, 120. Then you're having 120. When you try to get the closing balance, of course this is the opening balance, has to close from here. The carried down has to be this side. So I check minus 6. So I get 1,003,000. So you're seeing that now this is our new closing balance for what? So it will open the next year. It will be the balance blow down. So you're seeing that this is now the new closing balance for the branch current account. Now when you check the trial balance, of course, the closing balance for the branch, the head office current account was 103 million, which is exactly the same as now our new closing balance for the for the branch current account. So it means now we have made the two balances to reconcile because we are seeing they are the same. So we are going to, now we have started. Of course, we are preparing the income when they say combined statement of profit or loss for both the head office and the branch. This is you prepare it in the form of a T account. So this is the T account having the debit side this side and the credit side this side for both the branch and the head office. The branch and head office. So we are going to start. Of course, when you are preparing the income statement, you know that we start from the sales, and we start from the sales figure. And the sales, we know that sales have a credit balance. They increase by crediting. So even in this case, you have to mention that sales, you are supposed to start with your sales, but you recognize them on the credit side because they increase by crediting. You take the numerator of balance of the detail you are looking at. So sales, they increase by crediting. So I start from the sales. I look at the head office. The figure for sales in the head office is head office. It is 459,400. 459,400. If you check, it is 459,400. Of course, in the trial balance they gave, they put sales stock purchases, but you need to know that the one that relates to the credit must be belonging to the sales, not purchases. So head office is 459,400. Of course, the zeros, I forgot to include them, but zeros you can put them there to recognize that these figures are in thousands. Then even this 1,000. So you recognize those zeros because this is 459,400,000. Then when you go to the sales for the branch, they are showing it is 379,400. If we check the trial balance, 379,400. 379,400, yes. So in our income statement, we start from the sales, then we go to the part for cost of sales. And cost of sales start from opening stock. Opening stock, stock is an asset which must have a debit balance. So I go this side, I put opening stock. Opening stock. I check for the head office. What's the opening stock at the head office? When you check out trade balance, opening stock is 97 million. 97 million. So this is 97,000. When you check at the branch, the opening balance of stock is 30,800,000. Opening stock 30,800,000. So you have to check through a question because I'm just getting the answers from the trade balance, which was in our question. Then opening stock, because you are now at that part of the income statement, you have finished sales, then you go to opening stock plus purchases. So the detail here is going to be purchases. Purchases, of course, they increase by debiting. That's why we recognize them on the debit side. When you purchase something, the double entry is debit purchases, credit your cash. So we debit purchases here. They have a normal debit balance, purchases. So I look out for the purchases. The head office is 510 million. If you check, 510 million. So I write 510,000. We reduce the zeros. Then for the branch, recognize that here for the branch, the way in which the branch purchases is through receiving goods. So I'm not going to record it under. The detail is not going to be purchases. In the trade balance, they give it as purchases in the same column for purchases, but the way the branch purchases is through receiving goods. So the detail we shall take the detail as goods received. So it purchases through receiving goods from the what? From the head office. So but the purchases figure was given in the trade balance. So you recognize it in this line, which is the goods received were 297 million. So you recognize that. But you have to take note that for the purchases of the head office, remember the head office is going to purchase goods and then supply some to the branch. So it means that goods that are sent to the branch are no longer part of the sales. I mean the purchases figure for the head office. Goods that are sent to the branch are no longer part of the purchases figure. So you have to reduce this figure of purchases of the head office. And the only way of reducing this figure, it is on the debit. To reduce it, you have to pass a credit entry. So you have to pass a credit entry of goods sent. Recognize that the goods sent are no longer part of the, because the head office is going to purchase goods of a given amount, then send some to the branch. So it has to remove them from their purchases. So the only way of reducing this figure is crediting, and we credit that goods sent. So you look at your trade balance. The goods sent figure was 308,000. So we reduce them still in the head office column to show that we are reducing this figure by crediting. Then you can look out for, so opening stock plus purchases minus closing stock. Opening stock plus purchases minus closing stock. But you need to take note that in the question, in the additional information, you saw that they gave us something. They said something about the closing stock and opening stock. They are saying in additional information, they note one, all goods sold by the branch are supplied from the head office at a cost plus 10%. Cost plus, that is markup. Cost plus that is already markup, as long as they mention that word. So our markup is it is let's see, it is 10%. So it is 10%. So I turn it into a fraction. Of course, 10 out of 100. That is 1 out of 10. Our markup is 1 out of 10. So I have to use that markup to calculate the profit percentage on the goods. So this, since we have gotten our markup as 10%, when you turn it into a fraction, it is 1 out of 10. So I have to use the markup to calculate the profit percentage or the profit element. So I say markup is equal to gross profit over cost of sales. So markup is 1 out of 10, which is our gross profit over cost of sales. So 10 times, I cross multiply 10 GP is equal to cost of sales. But I remember that gross profit is the same as sales. When you check the trading account, sales minus cost of sales, which is equal to cost of sales this side. So continuing from this, I can have my 10 sales. This marker is marker. I can have my, when I enter the 10 sales minus 10 cost of sales as equal to cost of sales. When you take this one this side, you have 10 times the sales is equal to 11 cost of sales. So it means now when you make cost of sales the subject, you'll be having cost of sales is equal to 10 out of 11 sales. Of course, you know that the remainder is always the profit element, because now this is the cost. 10 out of 11 is the cost component on the sales. So it means the remainder must be the profit element on the sales. The remainder must be the profit component. So if the cost of sales is 1 out of 11, it means 1 whole minus 10 out of 11. I'll be getting 1 out of 11. So it means the profit element, profit is pi. The profit element is equal to 1 out of 11. So it is the one I'm going to be using to compute the profit on the opening stock at the branch and the profit on the closing stock at the branch. So I start. So of course, the reason why they gave you the markup is to get this profit element, and we have gotten it as 1 out of 11. So I'm going to recognize that my profit is 1 out of 11. My profit element, profit pi is equal to 1 out of 11 of the sales figure. So this is what I'm having in my head. So at this point in time, you're supposed to recognize those profit elements. For instance, but they said all goods are sold by the branch. All goods that are sold by the branch are supplied from the head office at cost plus. So it means we must calculate the profit element in the opening inventory at the branch and the closing inventory at the branch. Of course, the profit that you get on the opening stock is what we call realized profits. So we compute 1 out of 11 times the opening inventory at the branch, which is 330,800. So I compute that 1 out of 11 divided by 11 is equal to times. I'm getting 2,800. The profit that you calculate on the opening stock is what we call realized profit. So when you get 1 out of 11, the profit on this component of the inventory at the branch, we get it as 2,800. 2,800. And we call it realized profit, the profit on the opening inventory. But the profit on the closing is what we call unrealized profit. Unrealized. Profit on the closing inventory. Unrealized profit. This is realized, this is unrealized. So I can also now compute the profit on the closing, which is going to be 1 out of 11. Times now the closing inventory at the branch, because it is the goods at the branch which they told us that on which we are supposed to compute that markup. Because they said goods that are sold by the branch were the ones that were transferred at a cost plus markup. So you shouldn't compute that profit on the opening inventory at the head office. It is only at the branch. The inventory that is at the branch is where I calculate these percentages. So I go unrealized profit. I check on the closing inventory at the branch. In my question, I'm having closing inventory as at the branch. Let me first see. At the branch, I'm having closing inventory as 35,200,000. When you check additional information, the 35,200,000. So you check 1 divided by 11 times 35,200,000. It is in the additional information, the closing rate at the branch. So it is 3,200. 3,200. So we have computed those profit elements on the inventory at the branch. The opening stock of the inventory at the branch is what we call realized profit. Profit on the opening stock is what we call realized profit. But profit on the closing, we call it unrealized profit. It is a profit, but we haven't realized it yet. So recognize that we have calculated these two figures from the opening balances of at the branch and closing balance of inventory at the branch. But you have to take note that that profit doesn't belong to the branch. So you can't recognize it in the column of the branch. Yes, we've calculated from the figures of the branch, but when you are recognizing it, it must be in the column for the head office, because even if it is a profit that is made by the branch, it doesn't belong to the branch. It must be the head office profit. So it means you are going to now record this realized profit as an income. On this side, of course, income is increased by crediting. So that income must be recorded in the side of the head office, which we are going to call realized profit here. Realized profit, which is 2,008 in the column of the head office, because it was made by the branch, but it belongs to the head office. So you can't record it in the column of the branch. So it is realized profit, which is in the 2,800. So I'm recognizing my income is increasing. Then this unrealized profit, yes, it is a profit, but I can't take it as my income right away because it has not yet been realized. So I must be recording it on the debit side. It is an income, but you can't take it as it is not yet realized. It is a profit, but it's not yet realized. So you don't recognize an income. You have to recognize it this side of the debit. So I say unrealized profit, unrealized profit. Then you recognize that it belongs to the head office, which is 3,200. So from our income statement, we saw that we start with opening stock plus purchase. Of course, you start with sales, then you go to cost of sales, which is opening stock, plus purchases, then you less closing stock. And closing, of course, if if you are lessing, this is opening stock plus purchases. Then if you are lessing, you can't still put closing stock this side. To reduce this figure, you are supposed to pass a credit entry. So closing stock has to be this side. Closing stock. Otherwise, if you put it this side, you'll be like adding to these figures of opening stock and purchases. So closing stock has to be this side. Of course, closing stock at the branch, at the head office. Let me check here. Closing stock at the head office, it is 109 500. 109 500. Then the closing stock at the head office is 105. Then at the branch, in the additional information, they told us 35,200,000. 35,200,000. So can have this. So opening stock plus net purchase minus closing stock. So now at this point in time, because in our income statement we start from sales, we have finished the sales. Then we got opening stock plus purchases. We less closing stock, which is this one. Then we can get our gross profit. So it means at this point in time I can establish my gross profit by, let me do this. So I can maybe balance off this. When you try to balance off, of course, you are going to see that. When you try to balance off, starting from this column, so when you balance off, you are going to see that you are trying to balance. Of course, you are going to balance the branch column with this branch column this side. When you balance, this side is greater, of course, this side. When you compare this column and this one is greater. When you sum it up, you are getting 414,600. And this side, of course, you are going to use it to balance this side. So it's same figure, 414,600. When I try to subtract here, I'm going to be getting 416,600 minus these two to get my now what we are going to call gross profit, because we are at this step of the gross profit in our income statement. So I'm going to be getting 80. I'm going to be getting 86,800 this side. Now I also go to this column. I try to balance it off. When I balance off, when you add this side, of course, this one is greater than this side. So this is the total. I use this total to balance off this column. When I subtract, I was getting 269,500. So this is our gross profit, but we have to bring it, because this is the carry down closing balance. We have to bring them forward, brought down, to bring them down so that they achieve their normal rate of balance. So I say gross profit this side. Gross profit is, I bring it down this one. It is at the head office it is 269,500. Then this side at the branch is 86,800. 86,800. Then remember, gross profit you have to add on other incomes. You check whether there is any element of other incomes. In our income statement, after getting gross profit, you add on other incomes. So you check whether there is any element of the other relating to other incomes in your trial balance. When you check your trial balance, you are seeing that you're having profit and loss account. Some profit that wasn't recognized. So here you have to recognize it as under other incomes. So you add that profit, other incomes. We have profit or loss account. Profit or loss account that wasn't recognized. It is in our trial balance, meaning they did not recognize it. And it is the total of that profit is 110 million. So I add it 110 million. So on that figure, of course, gross profit, when you add on other incomes and then you less operating expenses, you can now reach your net profit. So on this figure, gross profit, I've added other incomes, which you got from the trial balance here, trial balance. Then, of course, on this gross profit, on this figure, you're supposed to less operating expenses. And the only way of reducing on this figure is passing a debit entry, because it is on the credit. If you credit, you are increasing on this figure. So you have to pass a debit. Or the other way of understanding it is that expenses have a normal debit balance. So they must be on the debit when you are recognizing them. So here we are going to be having our expenses. For instance, we are seeing in the trial balance, we have legal expenses. Legal expenses. We are having distribution expenses. Distribution. We are having distribution. So we had reached at the point of gross profit, whereby we added other incomes, and then the last step is you raise from the gross income. Of course, you have to less operating expenses. Expenses have a debit balance. You have debited them all the expenses. You don't forget that you have expenses relating to the head office and the branch, and you know how to compute for depreciation when it comes to expenses. You had some depreciation relating to motor vehicle, one relating to the furniture, then other relating to the buildings. So, of course, when I add, and then it's the last step in the income statement when you less operating expenses. So when you add, you try to balance the two columns. Of course, this side, when you balance this column, you're going to see that this figure is greater than this when you add sum up all this. So of course, you're going to use it to balance off this side. So it is 86,800. This side is 86,800. When you less it from all this, you'll be getting this as the carried down, our profit. Then still, when you come to the head office, you are going to balance off this column with this column. Still, this column was the biggest. Of course, you are supposed to be using this figure and this figure to get this total, not the entire column. This figure of gross income, because it is the gross income, all the gross income, which is gross profit from plus other incomes, from which you less over other expenses. So when you are getting this total, it is this sum of these two and even this one. It is what we less on, what we are supposed to less the other all these expenses to get our net profit. So this side, I added this and this, and I got this total. When you less this total from, you use it to balance this column. When you less all this, you'll be getting this balance. So this is our net profit. Of course, you can bring it down if the space was there to achieve its normal rate of balance, which is the credit side. So that's it for the income statement. But when you look at so for the part of the balance sheet, because you are supposed to prepare a combined balance sheet, for the balance sheet, the only thing that changes is that you have to specify, tell us that if you're looking at maybe non-current assets and you are looking at fixture and fittings, you have to tell us that you write, of course, the detail that is fixture and fittings. Then you tell us that maybe this figure relates to the head office and also this figure relates to the branch. So you specify what relates to what. You have when you are recording in the balance sheet, you have to distinguish what goes to the head office and what goes to the branch. So that's the only thing that changes, that you just put maybe a detail of fixture and fittings. You write head office, put the figure, branch, figure. Then when you go to the current assets, you do the same thing. That bank, maybe, then you tell us the amount of money that relates to the head office and also the amount of money that relates to the branch. Then you shouldn't forget also other asset items. For instance, we talked about cash in transit. Goods in transit, we had them, and even cash in transit. Those are current assets which must appear in our balance sheet. So basically, that is it with the balance sheet for the combined for these autonomous branches. So we are now done with autonomous branches. We decided with centrally controlled. Now we've looked at autonomous, and so we are just here to thank you for watching the video, and we ask you to keep subscribing for more videos because we want to look at other topics like partnership accounts. Thank you for watching the video.